Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. Governments around the world are getting serious about the impact of greenhouse gas emissions on the environment. The carbon tax that Canada has adopted is just one example of this push to get companies to clean up their act. But it's not the only one. Another avenue that's been growing in popularity around the world is the use of carbon credits. They're designed to help regulate the amount of pollution that's permitted each year and slap a cost on those that don't stay under the threshold. Get this. Investment firm Wood Mackenzie expects the carbon credit market to explode into a $22 trillion opportunity by 2050. Yes, that's trillion with a T. And with so much money on the line, the rising cost of carbon could start to factor into investment decisions in a big way before long. So, we're going to find out how investors can gain exposure to the carbon credit market and some factors they may want to consider as they do. Joining us is Hussein Allidina, Managing Director and Head of Commodities at TD Asset Management. Hussein, welcome back to the show and thanks for taking the time.
Thanks for having me, Brian. I appreciate it.
All right, Hussein, I have this is just for my own curiosity. I'm going to fire a couple quick questions at you. So, TD Asset Management is one of the relatively few providers of carbon credit funds. Why did you and your team decide to launch one?
That's a really good question, Brian. So shortly after I started at TDAM, um, the asset allocation team that I work on, and I spoke about kind of the opportunity in carbon, and particularly around carbon's use in a portfolio. We'll probably talk about this in more detail a bit later on, but as carbon is being priced globally, that is starting to have an impact on different companies that we invest in. And the idea was, is there a way that we can hedge that exposure as the price of carbon goes up? Those that are subject to that price will see their profitability challenged if they don't adapt and accommodate this sort of carbon price. So really, the motivation was a means to be able to hedge that risk in portfolios.
All right. Well, carbon credits have been around for several years now, but they're still quite niche among retail investors. In your opinion, why are carbon credits an emerging asset class that investors may want to consider?
Well, Brian, you said it, right? It's a relatively new market. Whether we're looking at cap and trade or even the sort of carbon taxes that we see in Canada, if you look at the data around carbon, the addition of carbon to portfolios is accretive because of the low correlation that carbon credit pricing has relative to the assets that are held in typical portfolios. And as I mentioned earlier, as the price of carbon increases, you need to think about the impact that that's going to have on your investments, and a way to hedge that exposure is via carbon credit. So I think it's a super exciting space. I think, notwithstanding the fact that prices have increased meaningfully from when systems were launched, most experts believe prices need to move higher yet in an effort to curtail carbon emissions so that we're able to reach our climate change objectives.
All right. Well, I'm excited to get into our greater conversation. I know our audience is always looking for new opportunities, so I think this will be really interesting for them to hear about. But just before we get into the rest of the conversation, I do have a trivia question. How much of the world's carbon emissions are covered by carbon pricing programs as of 2023? So we'll reveal the answer at the end of the conversation, so stay tuned. All right, so let's get to our conversation. First off, can you explain what carbon credits are and how they aim to incentivize companies around the world to lower their greenhouse gas emissions?
Absolutely. And before I do that, I just want to be very clear that when we're talking about carbon credits here, we're talking about compliance markets. Compliance markets are markets, pardon me, where entities that are covered by the carbon program are responsible for providing allowances in an effort to curtail emissions. So broadly speaking, you have a regulatory body that issues carbon credits to emitters. Those carbon credits are typically issued at a level that allows the most efficient player from a carbon intensity point of view within a certain industry to be able to continue to operate. Anyone that is emitting greater emissions than the cleanest emitter in that industry will then need to go into the market and buy credits in an effort to meet their obligations. The magnitude of credits that are issued in any given year are declining by policy, by regulation. If I happen to be a dirtier cement producer, for example, than the cleanest cement producer, I'm not going to get sufficient free allowances from the regulatory body. So I'll be forced to go into the secondary market to buy emissions from someone else who has received an allocation. And because their operations are cleaner, do not need those credits. I need to step into that market in the secondary market and buy those emission credits from that player.
I was surprised, and I think a lot of people are too, that cement producers, for example, cement produces a lot of carbon. So you're always thinking of these smokestacks and these companies that have these manufacturing, but there's other entities out there. Is that safe to say?
Yeah, there is. And actually, if I talk about the European system, today there is a certain cohort, let's say, of industrial participants that are covered by that carbon scheme. As time progresses, again, by design, the way they've designed the regulation, a increasing number of emitting parties will fall into scope.
Now that we're talking about an investment as well, is if you were to relate carbon credits to another more common financial product on the market that investors may be more familiar with, what would it be?
Yeah, no, I think the closest comparison um, is commodity futures contracts. So the way carbon is traded is very similar to what you see, for crude oil or for copper or for gold. The contract has an expiry date. So, if the carbon fund is holding carbon futures that expire in December 2023, I need to roll that exposure into a forward contract in order to maintain my sort of carbon exposure. Very, very similar to what you see in the commodity futures markets, and different than what you see in equities. In equities, of course, you can buy, company A and hold that stock forever, so long as the company is a going concern. That is not the case in commodities or in carbon.
So how has the price of carbon credits performed so far in the relatively recent history?
Carbon, when the program was launched in Europe, the European carbon credit program was launched in 2015. At that time, you were trading around €5 a ton, so €5 per ton of carbon. Prices started to increase as regulation got stricter, as transparency around regulation became more apparent, and through 2018 all the way up until sort of 2021, we traded from about €20 a ton up to €60 a ton. We saw significant price appreciation following um, Russia's invasion of Ukraine, because ultimately what that did is it forced Europe to burn dirtier forms of energy, right? When gas supply from Russia, Nord Stream 1, 2 was constrained, industry, power generation, and other industrial participants in Europe had to, look for alternatives, and those alternatives, unfortunately, included a lot of coal. Coal has a higher amount of carbon. We traded as high as €100 per ton. Currently, we're trading around €85 a ton.
All right. Well, how is the supply of carbon credits determined each year, and what could cause their price to rise or fall?
Yeah, so another good question. So the supply of, again, in the case of the European Union, which is where our fund currently invests, the amount of emissions is driven by policy, and they're very transparent with the policy. So they tell you sort of what the supply of credits will look like this year, but they also give you an indication as to how the supply of credits is seen evolving into the future. So currently, the European Union um, the cap which they've set on the number of credits that they allocate every year is decreasing by 2.2% every year. And that, again, by design, they're reducing the amount of free credits that they put into the market in an effort to influence the price of carbon, and by extension, influence the operations or the emissions of the industrial participants that are participating in Europe. On the demand side, I gave an example of, reducing my natural gas consumption because it's not available, and then instead burning coal, which has a higher carbon intensity. That, of course, is constructive for carbon prices because emissions are increasing and the supply is relatively fixed and declining through time. Another driver of carbon price by extension, or carbon emissions, is going to be general economic activity. Generally speaking, Brian, the amount of economic activity is going to drive carbon emissions and by extension carbon demand and carbon price. Um, I think for viewers, we have to appreciate that GDP requires energy, and energy, most forms of energy, are going to emit some degree of carbon. So if you believe in economic growth, you implicitly are believing that carbon demand is going to increase, or carbon emissions, pardon me, are going to increase.
Okay. So it sounds like you said there is that upside. There's a lot of benefit to the fact that it's, seemingly a growth market at the moment, and the fact that, if we have increasing growth in the world and GDPs of a lot of those countries that are involved, that'll be a positive for carbon credits and these investments. What are some of the potential risks that investors should consider before investing in carbon credits?
Yeah, so when we're thinking about carbon, the piece that is sort of most concerning from a risk point of view to us outside of economic activity is policy and regulation, right? The carbon cap and trade system in Europe or in California or in other jurisdictions exist, and they exist because policymakers have established policy, provided transparency, and effectively fixed the supply of carbon available. I was quite worried when Russia invaded Ukraine and energy prices moved higher that we might lose some of the resolve, or the policymakers may lose some of the resolve that they have with respect to these programs. I was surprised actually that they didn't change the program, and in fact doubled down. And some of the largest emitters in Europe said, look, this program is a good thing, notwithstanding the higher cost of operating. It is encouraging industrial participants to look for cleaner ways from an emissions point of view of operating. But yeah, Brian, the biggest risk outside of economic growth is a change in policy. Another risk, if we are able to increase our production of, for example, natural gas, which has a lower emission profile than coal, and substitute, that coal, for example, generation in power plants with natural gas, then I can have the same level of economic activity with a tempered carbon footprint, and you could argue that that would be a risk to carbon prices. Looking at the supply demand data and what's happening from a power generation point of view, I don't think that's a material risk, because the baseload level of demand is growing pretty meaningfully, and accelerating actually because of the energy transition and the move away from conventional vehicles. But that would be another risk that I would mention.
So, which parts of the world have developed a cap and trade system?
Yeah, so without kind of giving away the answer to your trivia question earlier, you have cap and trade systems in the European Union. You have a well-established cap and trade program in California. You've got a program in the northeast of the US. You have a lot of jurisdictions and countries globally that have some form of carbon price, whether it's a cap and trade, as discussed for Europe, California, the northeast of the US, or in the case of Canada, where we have, a carbon tax. And I think that momentum continues.
Like anything in life too, or any games you play, and I don't know if you're into sports. I know myself as well. There's always, you remember when you're a kid, there's the one that says, "If you don't play by my rules, I'm taking my ball home," something like that. Could that happen with this? Like, would there be an opportunity where a country could have emitters that just go somewhere else that doesn't have a cap and trade or a carbon credit system?
Yeah, absolutely. And actually, you see that happening in Europe right now. So if I'm an emitter in Europe, I'm subject to this carbon tax. If I can relocate my facility to a jurisdiction that does not have a carbon tax and then export that product that I'm producing into Europe, I've arbed the system. The Europeans have recognized this, and they are talking about something called a cross-border adjustment tax. And effectively, what they're saying is that if you are operating in a jurisdiction that does not have a carbon price, we are going to levy a carbon tax on the good that you are providing into our market. And I think this is quite clever, because what it's doing is it's forcing other countries that trade with Europe to think about imposing or implementing their own system. Right? They're saying that, look, we're giving up revenues that we could collect to improve emissions within our country. And so, yeah, to your point, there is a focus on kind of this arbitrage that exists right now, and I would not be surprised if in the next couple of years the European Union imposes this cross-border adjustment.
Excellent. So now that we understand how carbon credits work, can you tell us, why might an investor want to consider gaining exposure to them?
Increasingly, as the world's emissions are being priced, again, whether it's cap and trade or some form of government tax, that tax or that carbon cost is going to impact the bottom line of the companies that we invest in. My portfolio, I have exposure to energy producers. Those energy producers, if they're operating in jurisdictions where there's a carbon tax, that carbon tax is going to impact their profitability, unless they're able to kind of pass that price on entirely to the consumer. A way for me to hedge that carbon exposure is by buying carbon. We talked a little bit about the outlook for carbon moving forward, and the reality that the supply of free credits is decreasing. That portends to higher carbon prices. So I think there's an expected return argument as well, Brian, in investing in carbon. It is a volatile asset class, but if you look at what has happened to pricing and what most of the world's sort of experts in the space believe, carbon prices are going to need to go higher in an effort to reduce carbon emissions and to force folks out of coal and into cleaner fuels, alternatives, renewables, etc. And then finally, Brian, I think the motivation, and we touched on this briefly very early, if I look at the correlation of carbon prices with traditional assets, very, very low correlations, particularly stocks and bonds. And we know if I take an asset that has a low correlation to my existing portfolio and I add that to the portfolio, that improves the overall risk adjusted return of that portfolio because of the low correlation. And carbon commodities broadly exhibit a low or negative correlation to the sort of typical basket of assets that most investors hold. And for that reason, it pushes up the risk adjusted return because of that low correlation.
All right, so let's say an investor wants to gain exposure to carbon pricing. Then what are some of the ways or some of the options they have?
The most direct way, the way we do it in our fund, is we own the underlying carbon credits, so the derivatives that are traded on the exchange, and we roll that exposure. If you're not set up to trade commodity futures, which carbon is very similar to, then you search for an ETF that does that for you.
What are some of the factors that an investor may want to consider to help them research carbon credit funds?
What does the size of the market look like that my fund is investing in, and does it have capacity for my investment? That is important. I think the other thing that is important to understand is how the derivative exposure is rolled, right? We mentioned that you cannot hold carbon forever. You can't hold that December 2023 contract forever. It's going to come to, expiry, and you're going to have to roll it. Understand how that roll schedule works and how they're rolling your exposure, because there is, potentially some alpha to be had or lost depending on how you roll. And then I think for Canadian investors, be cognizant of the currency exposure that you have. Make sure that you're, investing in the exposure that you want. If you happen to be long carbon and you're long carbon in U.S. dollars and the Canadian dollar rallies meaningfully, your local return is going to be compressed because of that. So think about that as well, I think would be my advice.
All right, thanks for giving us the scoop on some factors to consider when researching carbon credit funds. Now let's take a moment to show our audience how they can screen for carbon credit funds in WebBroker. So you're going to go into WebBroker and click on Research and then Screeners. This is going to pull up that screen I was just on, and I'm going to select ETFs. So now that I have ETFs, I did a little bit of research ahead of time. I took a couple of the more popular Canadian and US ETFs and found out what categories they trade in, and we're going to go to Create Custom Screen to see if we can find more ETFs within those categories. So I'm going to select fund category. I'm going to add that to my screen. It was a blank screen down at the bottom, other than we have Canada and the United States. And I'm going to, on the drop down, I'm going to select Canada first, but on the drop down, the Canadian category was known as Canada Alternative Other. So if we select this one, it's about the fifth or sixth one down. Now we see we get 37 matches. I'm going to exclude the mutual funds. We're going to click on View Matches. And not all 35 are carbon-based or carbon credit ETFs. There's a lot of Bitcoin and some other things. So I'm going to have to sift through and see what I can find that is carbon-based. So as I scroll down, I can see closer to the bottom, I have this CARB and CBON, so 9-point carbon and Horizons carbon credits. And if we go to the second tab, there's one down at the bottom. This is TD. Global carbon. I believe there's one at the top here as well, which is the 9-point carbon credit ETF. So now I can do a quick comparison. If I click on compare, I can do a side-by-side comparison and get a lot of the key data and information that I would need if it's available. Some of these have missing data because they haven't been around long enough. If they've been around less than a year, they're still compiling some of the data and the rankings and things like that. But this will get you started, and you can buy them right from here too if there's one that you are interested in. And then if we go back to the ETF screen, we can now see if we want to look at some US alternatives. So we're going to go to the edit screen, and I'm going to exclude Canada. So we'll just look at just the US. We'll take Canada off there. And we're going to add the United States. And the actual category for the US was commodity focus. So you have to go a little bit slow as you're scrolling down because it does go pretty quickly. But you're going to look in the actual brackets. You're going to look for the United States and then commodity focus. So let's see if we can find that one as we're scrolling down. There's commodity focused right there. We'll select this one, and we're getting 76 total hits there, total matches. We're going to open those up. And now this one's even a little bit trickier. There's a lot of commodity ETFs that are available, so you got to do a close look at what's available on the screen here. There's one here, the NTRL Carbon Credit Strategy. I believe on the third tab. There wasn't really, when I first looked, there wasn't really any on the second tab. So now you can see within the letter K, for example, there's a few, this Crane shares, European carbon allowance, there's California carbon allowances, Crane shares global carbon offset, and I believe there's a few more as we go through some of the other tabs, but that's a few to get us started. And once again, you can click on compare, you can get that information. Some of them may have more, but if they are fairly new, there may not be a lot. But it will get you to the point where you're getting started and identifying some carbon credit ETFs that you may be interested in investing in. All right, Hussein, we're going to have to leave it there. Thank you for introducing us to carbon credits and the funds that invest in them. Now, before we wrap things up, let's reveal the answer to our trivia question. As a refresher, the question was, how much of the world's carbon emissions are covered by carbon pricing programs as of 2023? The answer is roughly 23% of global greenhouse gas emissions are covered by carbon pricing initiatives as of 2023, according to data gathered by the World Bank. There are 73 carbon pricing initiatives worldwide, with most concentrated in Europe and North America. So Hussein, what do you think about that? What's your thoughts on that trivia question? I'm sure you knew the answer to that, but what's your thoughts there?
Well, look, I think what's really interesting there is, so 73 jurisdictions that have a carbon price. I think that's pretty meaningful. I think what's even more meaningful, Brian, is if you had asked that question or posed that question, in 2010 or 2011, that number was actually, a fraction of that. According to the World Bank, there was 20 jurisdictions in 2010 that had a carbon price, and importantly, it was only 5% of the world's emissions in 2010 that were covered by a carbon price. In 2000, so go 10 years even before that, you had three initiatives globally covering 2% of the world's emissions. So in the last 20 years, we've gone from, two or three initiatives to north of 70, and we've gone from 2% of the world's emissions that have a carbon price to nearly 25%. And I bet that if we have this conversation, you know, 5 years from now, 10 years from now, the number probably doubles even more given the momentum behind the need to address carbon.
Absolutely. We'll have to have you on, maybe not 5 years from now. Maybe we'll do that again and we'll take another look.
Awesome. Thanks for having me today.
This was really interesting for me, and thank you for clarifying some of those terms like correlation and other things that we did talk about, and just giving us an idea of an alternative investment that you could possibly hedge your portfolio with or add to your portfolio. Do you have any other last thoughts to leave us with?
Yeah, look, no, I'll just say that it is a volatile asset class, right? So I think people need to appreciate that. Directionally, I believe that the world's concern around emissions is not going away. And I think it's important. I think that if we want to reduce the amount of carbon that is being emitted, we have to price it. And I think that momentum is there. And again, I think from a portfolio construction point of view, carbon is very interesting in portfolios.
Thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.